What's going on, YouTube? We're back. Um, keep getting distracted trying to make these videos, but yeah. So we're back. Next video, we're gonna go over Fibonacci. Fibonacci, man, great tool. Um, Real great tool. I love it. Um, I don't use it as much. Well, I'm not gonna say that. I do use it, but not as much. Um, once you've been trading for a while, um, trading kind of is like related to life in so many ways that people don't understand. Um, I always tell people I've been trading now since like early 2016, and over a course of time, once you learn so many things about trading and you see so much about trading, your eyes get kind of used to seeing stuff. And I'm gonna quote one of our favorite street quotes: "If you've been in the streets long enough, eventually you'll be able to eyeball the work, right? And if you know what I'm talking about, you know what I'm talking about. If you don't, you're just lost in the sauce." But moral of what I'm saying is Fibonacci is a retracement tool, right? It helps you identify potential reversal areas or projections on where price is going. Um, it's literally just a tool, like I said, just to identify or figure out price reversal areas or a continuation of a trend or possible break of structure. Um, Fibonacci is a real person. If you didn't know, I recommend if you're a person that's deep into life and like having better understanding of certain things, go check it out on YouTube. Type in Fibonacci theory. It goes deeper than just trading, but it's so cool because it goes hand in hand with trading with a lot of life elements. Um, Fibonacci came up with a theory saying that life has a certain way of moving and a certain rhythm in life of how it goes, or certain patterns, or how things play out. Just like the fingerprint on your fingers, right? How everybody is unique, but it says something. Fibs, like I said, is a tool that kind of gives you projection on what's going to happen. So we're going to just, take some time and chart up EJ, and I'm going to show you how Fibonacci works, and why is it such a powerful tool to use. And just like the rest of my videos, combine these with other elements that's on my channel. You can honestly see your trading style grow just due to the fact that you're combining elements like Fibonacci, supply and demand, support, resistance, trend lines, and market structure alone. And I still got more content coming that I want to give out to you guys, because at the end of the day, like I said, my goal is to change the mindset that you can't learn this for free. A lot of this information that I'm even about to give out is already out here on the internet. It's just hard for people to find, and I'm trying to make it a more valuable source or more reliable source where people can go to and get it. I feel like at the end of the day, people should only when they come down to trading, I feel like that people should only really need coaching and mentorship, right? I feel like you should be able to just find the info, study it yourself, be self-sufficient on your own, and if you pick it up, you pick it up. If not, that's where coaching and mentorship comes into play. I mean, let's think about it. You have people out here that play sports, right? And not every football player was a great football player at once. He needed straight coaching and mentorship, right? I myself was a football player and a track star. I had natural speed, but I had to get a track coach to coach me properly on how to run the track. Football, I was naturally just gifted because I loved the game, but I needed to have a coach and a mentor on what to do on certain things and what to look for on certain plays, or certain defenses, or all type of stuff. That's why I say trading, it lines up with life so much that people just don't understand it. But enough of that. Let's go ahead and get into this Fibonacci. So, like I said, Fibonacci, it's a retracement tool used to figure out price reversal areas, or a continuation of a trend, or a break of structure. Um, with Fibs, right? If you're using TradingView, you want to go over here to the left side of your chart. If you see it's going to be three boxes, click the third box down and the arrow beside it. It will say Fibonacci retracement. All right. So how we draw up fibs, right, is the key thing. How you draw up fibs is super, super important. Due to the fact that, if you draw fibs wrong, you're going to get the wrong projections, and that's what you don't want. Um, so to give you guys a quick example of how to draw fibs, I like EJ because of what it's already done this week, and I've kind of already seen it. And I'm like, hey, might as well go ahead and chart up EJ and show it. So the first thing you want to do is identify your point A and your point B. In this current situation right now, where's my arrow? In this current situation right now, this would be your point A right here because this was the start of this down movement, right? And I'm not going to draw on this block here. I'm just going to do this first down movement to show you guys how fib works, all right? And you're going to draw to your point B, which is going to be your first area of support. And what I mean by that is when price was coming down bearish, right? All these bearish candles, right? When this bearish candle finished forming, immediately it was followed up by a bullish candle. That is support. That means a price found some level of support here because it stopped that bearish momentum, right? I know some people might see what happened right here, but this is not true support because if I go to a higher time frame, these are probably just going to be noise, right? So if I click out like on a weekly, as you can see, that was just noise. But if you look at this, it's some type of little stall right here, right? Some type of slow up, and that's letting you know it was some type of support here, which is on the daily. So how we draw up fibs, right? You want to take your Fibonacci tool and you want to draw your from the top part of your start of your breakout candle. So this was a bearish move. You want to start at the top of this candle or wick. It doesn't matter. If it doesn't have a wick, put it on the candle. If it has a wick, top of the candle. Top of the wick. So we're gonna draw it off to the side. I always like to draw mine on the side due to the fact, so I can actually see where I'm pinpointing this, all the way down to where price found support at. Right now, if you see all these numbers that popped up on the side of the screen, those are your Fibonacci reversal zones or whatever. However you want to call it. Everybody has different terms for it. I'll just call them PRZs. So the main PRZs on fibs, the ones that we pay attention to, are the 38.2, the 61.8, the 78.6, and the 88.6. And if you got pen and paper, I suggest you write that down. Those are your main reversal zones. Now, how fibs work is, like I said, it's a retracement tool. So pretty much what it's identifying is the counter trend that is going to be happening when you actually measure the push of what the market did. So right here, right, this is your push down, and this is your counter trend, right? And what ended up happening is when you measure this out, price came back up and they rejected right at 38.2. Like I said, those are your four major levels, and your four major levels have some type of significance, right? Your 38.2 is going to be your strongest rejection level. So if price retraces to 38.2 and it rejects at 38.2, that is going to be your strongest retracement or your strongest rejection. So expect a more volatile push after price rejects the 38.2 retracement level. If for whatever reason it retraced up to 61.8, understand that that is a moderate retracement level, meaning that when price gets there, if it retraces to 61.8 and rejects that level, understand that the movement may be a little bit more slower for it to get to where price wants to go. And lastly is 78.6 and 88.6. I'm going to just stick that in the middle. Because as you see, these are more of a tight zone. But those are your weakest retracement points. If for whatever reason price retraces all the way back up to 786 or 886, understand that, like I said, the movement for whatever way or direction that price is moving is going to be a lot slower than anticipated, right? But all in all, if price gets to one of these reversal zones, and it actually respects that reversal zone, look for it to obviously probably continue the way that it's going. Now you do have to take into consideration where if price does do stuff like this, I'm gonna just draw this on here real quick, and then we're gonna continue with everything. So let's say you have a push to the upside and it respects 786. Price might come here, respect 61.8, right? It did come back up and respect 88.6, and then respect 78.6 and possibly go up to be 100% retracement. That's possible. It's a whole bunch of scenarios. You just got to be excuse me. You just got to be a very smart trader and understand that excuse me, I'm probably getting sick right now. I don't even understand. But you just got to understand that these levels are just like support resistance lines or zones or whatever. Not anything's indefinite, right? But like I said, if price action, these candlesticks show you that rejection happens at one of these levels, and it's a strong rejection, like you know for sure, hey, this is concrete, solid price action rejection, then yeah, you're more confident. But you always got to be cautious because a situation like this, even though 38.2 is your strongest retracement or rejection level, like I said, price can still retrace back to all these levels. And you see why I put out my pip counter, because I want you to take into account to, the space that it can retrace and how many pips that it can be. Right, like I said, if you put a sell here at 38.2, you got to remember price can probably still break 38.2 and go to 61.8, which is what, right at like 70 pips, and then they can still go to 786, which is about 120, and then up to 88.6, which is 150, and then if it goes 100%, that's about 180 pips. So remember, it's just a retracement tool to tell you where price is potentially going to retrace to, and if it rejects that level, it's going to continue. So in this scenario here, right, what ended up happening is this is your point A, right, all the way down to where price found support, which is your point B. You had a 38.2 retracement and a nice reject, and price went down to negative 2.7, which is take profit 1. Literally from this rejection level, you could have probably placed a sell. Price went against about 13 pips. This is where risk to reward or your risk to reward and risk management plan come into play. Because if you didn't, guess what? You're all in the wrong. So as always, let's take out a short position, right? Because we got a 38.2 rejection. Let's bring this in some. I don't know why that went out so far. All right, cool. But yeah, so as always, pull out our short position or our position counter. 33 pip stop. Double it. Easy. Got it. Right? Even though, like I said, looking at this on a higher time frame, like the daily, we know our negative 2.7 is literally our take profit 1. And which is a lot further. Now, I forgot to say this in the beginning of the video. Remember, whatever time frame you draw a Fibonacci on, um, the more significant that move is going to be. I used to draw fibs another way, and I'm going to show you guys in a second. But the reason why I like the way I do it now is because if you're going with the overall setup of what the market is doing, right, you're going to be on the right side of things. And to give you guys an example, we're on a monthly chart, all right? This is a high point. Price came down, made a low, made another high point. Now, even though this low is not lower than this low, it's still kind of keeping the structure of going down. And this is all on the monthly. So let's go to another time frame, which will be weekly. Another low high point. We're going to change these to orange. Another low high point. Another low high point, right? So based off the monthly to weekly, we already know what price is in a downtrend. So if I'd have went to the daily, right, and before I continue, this is where a lot of people mess themselves up in trading. A lot of people stay on the daily time frame, right, and you'll see this current little uptrend right here, and people will think, hey, the market's in an uptrend. It's in an uptrend. Yeah, this is a counter trend on what's actually going on. Prices is going up to make, this lower high. Now, there's nothing wrong with following this trend, what I'm saying, for the set period of time, because it's going to take a while for it to do what it's going to do. But if we were looking at this and we were already right here, like I said, a lot of people just follow what's going on the daily. And it would have been saying, hey, it's probably going to still go up, especially once you start on the daily, then you go down to a 4 hour, because now you're looking at it like this. Zoom out a little bit here. All right, now you're looking at it like this. And you're like, oh, well, it's hard to make certain decisions on things based off of how, I like to do it now. This trend line, like I said, if we sit here and now we know, hey, this is a lower high point on the weekly. So price came up here. Like prior to this even happening, watch this. Prior to this down move even happening, right? This would have been your initial push right here to the upside. So what we're going to do, same thing as before. Last bullish candle before it took off. From that wick to where that bullish candle went. So literally, hold on a second. Point A. Point B, right? Now we were looking for our retracements. What price do? Price dropped all the way down to 110%, right? It went all the way down to 100%, 110%. Once price goes over 100% of the initial push, that's called break of structure, right? Literally, so price went above, it went and broke structure, came back and tested 786. Now, normally what I do is once I see that structure has gotten broken, because let's say you didn't be able to catch this down move for whatever reason. Remember, trading is a patient game more so than anything, so you're not going to catch every move, right? But if you didn't catch this move, but you seen, hey, from this push up, price went over 100%. That's break of structure. So the next course of action would have been to flip Fibonacci from bearish candle, like we did earlier, to bearish candle. Boom. So this would have been, like I said, your point A. I got to redraw this one, but your point A to your point B, right? And what happened? Like we said, 38.2 rejection, and we already know the rest. Which price went about what? Already take profit one, that's 190 pips. So you could literally held that trade for a while. And then the cool thing about when it rejected at this 38.2 level, is some support here, right? Let me get my trend line too. It's some support right here. Straighten it out a little bit. And I'm going to move fibs real quick. And how did I notice the support? Price came down. Bearish candle, bullish candle, took it back out. Boom, boom, right here. This was that last level of support before price came back out here. And boom, boom, retest, drop. Literally easy 190 pips. Let's draw another one real quick. And then I'm going to show you guys how I used to draw it, and then we'll wrap this video up. So, another push right here, right? Starting from bullish candle all the way up to where bullish candle ended. Point A. Point B. Retracement. Price came all the way down. This is technically, to me, a 786 retracement because it broke above 61.8, but it respected the 786 level. But all it did was respect it, All you got to do is gut it down, go to a lower time frame, and literally go check it out. Not the cleanest double bottom, but it's a double bottom nonetheless. Price came down, found this ceiling. Excuse me, its floor. Came back up, came back down, found another floor, up to the upside, all the way up here to negative 27, which is take profit 1. And you don't even have to aim for, crazy high take profits. Over 390 pips, easy. And it's all about just being able to identify what's actually going on in the market versus, just marking stuff up. Let me actually show you guys how I used to draw Fibonacci. Clear off these charts real quick and go down to the hour. So how I used to draw fibs, I always used to have session breaks up, which actually just separate the trading day. All right. Let me give you guys an example, which a lot of traders can fail on, right? Let's say that this was, something you were looking at, right? And we were drawing up fibs for this day right here. You put an arrow here so we all on track. You're drawing fibs in this box, right? When you draw fibs in this box, it's telling you what's going to happen in this box, right? It's just literally giving you a projection what's going to happen the next day. And how I used to draw fibs is whatever happened this day, you draw it from the high that day to the low or the low to the high. In this situation, high to low. So high to low. Now, what happened on this strategy, when the way I used to draw it up, is whenever price gets to this zone right here, right, your market structure typically forms in that area. This is the old way I used to do Fibonacci. I don't do it this way currently. But market structure is supposed to form here. And this is why I don't use it no more, because to me, this will be more so of a fake out than anything. Because, right, if we're looking at this could be, a possible double bottom, right? But look how long price just sat here and struggled before it actually did take off. Now, yeah, it did go in the general direction we would have wanted to go, but you only got 30-something pips out the trade for one. And for two, the way I was taught before is once price, breaks above 38.2 and closes above it, you want to see push to 618 and do the same thing. Push above 786 to do the same thing. And I used to have two take profit levels on here that were, I might still actually have them. Let me go to my settings field real quick. Yeah, this one here, 618 and 127. Let me take off 110 and 120 real quick. So that's normally how my old fibs used to look, right? Because now I'm looking for price to literally go above in this scenario, right? Even based off of what we're looking at, we got a double bottom bullish engulfing, and price went above 38.2, went above 61.8, went above 78.6 with a strong close, a lot of volume, right? A lot of volume. But remember, a lot of times people do this in trading and don't realize it. We weren't even looking at higher time frames. So, we're thinking to ourselves, well, hey, it might be a time period for price to go back up. In the whole kill, this has been a down setup the whole time. And that's why price went above all these levels and actually, shot down. This is why I don't use fibs this way no more. Because based off of the old way I used to do it, my projection would have been for price to go all the way up here to 127 and 1618, which is take profit 1 and 2. Like I said, now if I were in this for the long position right here, let's do our risk plan, 33 pips. Usually try to go 2 for 1, right? Now, like I said, yeah, we would have gotten it, but a lot of times traders wouldn't have caught that, right? Because literally this candle was at 3 in the morning, and a lot of traders are not getting up at 3 in the morning. That's real. Like I'll be getting up at 2:45 to 2:30 in the morning to just assess trades or manage trades or even sometimes put trades in for London. But not too many traders are actively getting up to trade London session. And during this day right here, this was at 9 in the morning. So if you'd have seen this play out, literally deleting this feels real quick. Look how much consolidation happened right in between this time period. You know what I'm saying? This is all consolidation before it took off to the upside and then ultimately just went against you. So that's why I don't draw Fibonacci the old way I used to do it. But as I said before, just keep in mind whatever time frame that you do decide to draw Fibonacci up on, just remember how it's going to play out based off of that time frame. And the higher the time frame that you're drawing on, the more significance that Fib is going to have. But other than that, that's Fibonacci. If you guys want the levels, here we go one more time. Actually, I need to change it back. Boom, boom. Take this off and that off. So everything that's marked on here, you can pause the video, take a picture, screenshot, whatever you need to do. These are the levels that I use on Fibs now. And like I said, just identify the actual push, point A to point B. If it's a bullish movement, bullish candle to bullish candle. If it's a bearish movement, bearish candle to bearish candle. But make sure you're finding where it finds a level of support and resistance before you find that point A and point B. But other than that, that is Fibonacci. As always, study, study, study. Take notes. And happy trading. See you guys in the next one.